Smaller business owners in South Africa face a dilemma when thinking about exiting their business one day. What exit strategy will yield maximum value for you, the business owner? Typically, smaller businesses are managed by one or two entrepreneurs who take responsibility for the most important aspects of running the business, including sales, operations, and finance. When I look at smaller businesses, I often find that the business is largely, sometimes entirely, dependent on the continual involvement of the business owner from both an operational and a financial perspective. The result is that the most that such a business owner can expect to sell their business for is a fire sale value. Assets minus liabilities. Why do I say this? If your business requires the continual involvement of an owner-operator with your skills and experience, then the only type of buyer that you are likely to attract to your business is another owner-operator. An owner-operator is a person, possibly from your industry or a related field, having the requisite competencies with a willingness to work in a business like yours, and importantly, a person with capital to buy your business. And it is here with the last point that we find the main problem. Very few prospective individual buyers have capital of sufficient value to buy your business for more than a fire sale value. But a fire sale value is unlikely to be enough for you to sustain your current lifestyle. You must find an alternative exit strategy, a way of disposing of your business interests that will yield an acceptable amount of money. But before I start, I'd like to briefly introduce myself. Firstly, please understand, I am not a business broker. My name is Dion de Bruin. I run a consultancy business called Constructum Consulting. I take a minority stake in smaller businesses that I believe has the potential to be developed into an asset of value, a business that may be sold to investors at a premium to its asset value. I enter into an agreement with business owners where we work together over an extended period to consider the current value of the business, identify the factors that detract from the value of the business. We develop a vision of what the business should look like within a specific time frame, and then develop an exit strategy that will maximize profits from the sale of the business. Nothing about this is easy. To successfully develop a business into an asset of value requires commitment from the owner to a process that is at times burdensome and will require sacrifices. But it is worth it in the end. What is the alternative? For many owners of small businesses, the alternative is to wait until someone makes you an offer for your business. Often, not very much money and with unfavorable terms. But I believe you can and should do better. In this video, I introduce a strategy that may be best described as a hybrid management buyout with external investor exit strategy. This strategy is one of many options to consider. I use this strategy for this video because I believe it is applicable to many smaller businesses and it serves as a context within which I illustrate the methodology of preparing for a successful business exit. This exit strategy is designed to develop the business into an asset of value, an appealing investment opportunity for investors over a period of 5 years. I consider how to calculate the value of your business, how to identify the factors that detract from the value of your business, what your business should look like, the business characteristics to make the business attractive to investors, and how to craft an exit strategy to maximize the amount of money that you can get for your business. Keep in mind that this hybrid strategy consists of 2 parts, the implementation of which is staggered over a specific time frame, namely the management buyout first, followed by the sale of a majority stake to an external investor. But first, let me explain what a management buyout is. A management buyout is the sale of a business in part or in full to the management of the business. For the purposes of this video, I propose a hybrid exit strategy where the founder of the business that is the first part, by selling a minority ownership stake to 3 managers, namely a sales manager, an operations manager, and a financial manager. What I aim to accomplish with this first step of the exit strategy is, firstly, attract, recruit, and retain talented people who can make a substantial contribution to growing the value of the business. Secondly, build a management team with skin in the game, a team of people with vested interest in the success of the business. And thirdly, develop the business to a point where it becomes an attractive investment opportunity for investors. The second part of the strategy is to successfully sell a majority ownership stake to an external investor. This second step is where the founder of the business makes the lion's share of the profits. But let's not get ahead of ourselves. First, we must consider the value of the business in its present form. Much has been written regarding methods of valuation for smaller businesses. Most of the valuation methods promoted on social media and the internet originate from first world countries where copious amounts of data are available, including information about the price at which smaller businesses in various industries change ownership and the earnings of those businesses over the preceding years. Investors in first world economies can derive earnings multiples with which a business valuation may be produced. The market for smaller businesses in South Africa is much smaller and less developed. Consequently, information about the value and earnings of smaller businesses is scarce. No reliable earnings multiples can be derived. A more sensible way of calculating the value of a business locally is to consider the expectation of investors in terms of investment return versus risk. A positive relationship exists between risk and return. The higher the perception of risk associated with a particular investment, the higher the rate of return the investor expects. An investment in a smaller private company is seen as high risk. Consequently, investors expect a return on investment in the region of 25% per annum. A simple way of calculating the value of a smaller business is to take earnings, operational income, as reflected in the profit and loss statement, and divide this value by 0.25. Here is an example. Average operational income over the preceding 3 years amounted to 1 million rand. Divide this by 0.25 and you arrive at a value for the business of 4 million rand. This is certainly a simplified method of valuation, but it's a starting point. In my experience, highly complex methods of valuation often result in a figure not materially different from this. Owners of smaller businesses face a conundrum on two fronts. Firstly, the value of the business as per the calculation is not enough to provide the owner with a sustainable post-exit income. And secondly, very few prospective owner-operator type of buyers have sufficient capital with which to buy the business even at this low value. The result is that many owners of smaller businesses end up liquidating their business, which yields no more than a fire sale value. Now, let's consider what common factors detract from the value of smaller businesses. Firstly, dependency. For many smaller businesses, the most profound detractor of value is the dependency of the business on the business owner. Consider a scenario where a business owner assumes responsibility for sales, operations, and finance. The business owner is doing 3 jobs. I remember being in a similar situation. When I was out selling, I neglected operations. When delivering services, I neglected finance or compliance. I did 3 jobs, none of which very well. Nobody is good at all aspects of running a business. Often, entrepreneurs come from a sales background, being exceptionally good at closing deals and managing relationships. But salespeople are notoriously bad at admin. Savvy entrepreneurs, potential buyers of businesses, understand that customers do business with people they like and trust. If the majority of customer relationships vest in the current owner, what guarantees do the new owner have that existing customers will continue to support the business? What if the seller decides to join a competitor business and the customers follow him there? Existing customers are under no obligation to continue buying from the business. If the current owner is in effect doing all the work on which the operation of the business depends, what exactly is the new owner buying when the current owner leaves? Not much. Used operational assets, mostly. The result is that the business is worth no more than the market value of the assets, a fire sale value. The next factor that detracts from the value of the business is transferability. On a rudimentary level, a business consists of people with the right skills and character traits to do the work, processes, tasks done in sequence to produce the product or deliver the services, and policies, the rules about how things are done in the business. As an accomplished business owner, you have developed skills. You have learned lessons. You run the business by the seat of your pants, on intuition. The decisions you make with regards to suppliers, pricing, employees, customers, and money matters are all informed by knowledge built up over many years. and residing deep within the recesses of your brain. You know what to do next, and keep track of tasks in your head. And you can, because you've been doing it for so long. But knowledge, skills, and experience vested deep within the person of the business owner is no good to whoever must take over from you when you sell the business. The continued success of the business depends in large part on a transfer of knowledge. A business where all the skills and knowledge leaves with the current owner at exit is worth no more than the market value of the assets, a fire sale value. The next factor to consider that detracts value from the business is customer concentration. In the world of small businesses, sales success is often a function of customer relationships. Entrepreneurs with strong people skills build and maintain long-standing relationships with key customers. And since the business owner must juggle various roles concurrently, time available to selling is limited. The result is that the smaller businesses end up depending in large part on sales revenues originating from a small number of loyal customers. This represents a real risk to a prospective buyer of the business. As mentioned before, customers are loyal to individuals with whom they have a strong relationship, not with a business. The new owner has no guarantee that the customers will continue to buy from the business when the original owner leaves. The next factor we consider is indebtedness. Financiers providing debt finance solutions to businesses will almost always insist that the owner of the business accept personal responsibility for the business's debt by way of a personal surety or by providing an asset as collateral or security for the debt. Financiers are typically not prepared to transfer liability for the business's debt to a new owner, and certainly not without assessing the credibility of the prospective buyer of the business. Typically, prospective buyers look for a business clean of any debt, where the current owner settles all business debts at exit. The last factor that we consider that detracts value from the business is muddled up records. Very often, entrepreneurs put personal expenses through business accounts. This is very problematic from the perspective of an external party reviewing the financial and business bank account statements to determine the value of the business. Not only does this practice reflect poorly on the professionalism of the current owner, but brings into question the reliability of the financial statements. Can the information contained in the financial statements be trusted? Does the information reflect the actual value of revenues and expenses? No professional investor wants to spend valuable time sifting through bank account statements to distinguish between bona fide business expenses and spurious personal expenses. These are common factors that detract from the value of your business. I'm certain that other industry-specific factors may also be identified. For this video, I limit the conversation to these 5 factors. Begin with the end in mind. The next step is to create a vision of what the business should look like in 3 to 5 years when you plan to present your business to prospective investors. What is your number? assuming that you are prepared to invest the time, effort, and money required to build a business into an asset of value. How much money do you want for your ownership interest in the business? And importantly, by when do you want to sell? Let's assume that you want to build a business into an asset valued at 10 million Rand in 5 years from today. Based on the same method of valuation as presented before, what average operational income must your business generate to arrive at a value of 10 million Rand? Multiply 10 million Rand by 0.25, and that 2.5 million Rand per annum is the average operational income that your business must generate over the next 5 years. Now, before we talk about the changes you need to make in your business to accomplish this, let us consider what type of buyer is most likely to have the capital for a business valued at 10 million Rand. An owner-operator type of buyer is very unlikely to have 10 million Rand to buy a business. So let us just ignore this possibility. What about an individual angel investor? Angel investors are individuals, more often senior, accomplished individuals with substantial amounts of money to invest. According to the latest report of the Southern African Venture Capital and Private Equity Association, investment by individual investors in private businesses accounted for less than 4% of total capital invested, a very small and highly contested marketplace indeed. Furthermore, individual angel investors invested on average less than 5 million Rand per transaction. The prospects of investing 10 million Rand in a single business is a little rich for most individual investors. But could you convince an individual investor to buy 50% of your business at 5 million Rand? This is a more likely prospect. But what characteristics will an individual investor look for in a business? Angel investors are not looking for a job. These guys don't want to take over the running of a business from you. What an angel investor wants is a business with good prospects for capital appreciation, earnings growth of at least 25% per annum, a business with an established management team and preferably a team with skin in the game, a business with a well-diversified customer base, a business with little or no debt, and accurate, transparent, and dependable financial reporting. Now that you've got an idea of what your prospective investor is looking for, you need to craft an exit strategy. Again, I would like to reiterate that what I present here is just one variation of one type of exit strategy. Circumstances differ. Every transaction is unique. With this hybrid management buyout with external investor strategy, I propose the following. Exit, that is sell your ownership stake in 3 parts. First, sell a minority stake, let's say 30%, to the management team staggered over the next 5 years. I will explain more in a minute. Then, secondly, sell a majority stake, let's say 50%, to an external investor in 5 years. And lastly, dispose of the remaining 20% either to the management team and or to external investors in 8 years. The overall objective of this strategy is to grow the value of the business to a point where a substantial amount of money may be secured from the sale of a majority stake in the business to an investor, all of which is contingent on the establishment of a competent management team with a track record of successful trading supported by a set of trustworthy financial statements. It is not possible to include all the details of what needs to be accomplished to build a business into an asset of value in one short video. For the remainder of this video, I provide you with a 7-step process, which is in essence the main aspects of what comprise a field of study called business finance. Business finance is about creating, growing, and ultimately realizing shareholder value. Shareholder value for you, the founder and first investor in the business. To build a business into an asset of value, adopt an investor mindset. The starting point is to come to grips with what is shareholder value. After all, at the end of the day, you want to sell your business to an investor. What will a prospective investor think of your business in its current state? I already identified some of the common factors that detract from the value of a business. What other factors can you identify? What is your business worth today? You must have a starting point and then set an ultimate goal of what you hope to one day sell your business for. Craft a strategy to create value. As an entrepreneur, you must craft a strategy, a set of decisions about the direction the business will take to create a unique mix of value for customers, suppliers, and shareholders. This cannot be a cut, copy, and paste business. It's not enough to replicate what competitors are doing. The business must derive a clear value proposition from its strategy that gives the business a substantial competitive advantage. This is the first question investors ask. How do you win? What gives your business a competitive advantage? How would you answer? Does your stated value proposition represent a compelling argument to investors? Design a business model. To accomplish your strategy, you must design and assemble the various parts of your business in support of your business's value proposition. You must create a machine, a business consisting of people, processes, and policies. And this is where the establishment of a management team becomes critical. What do you want your business's organogram to look like in 5 years? What are the tasks that make up your business's core and ancillary processes required to produce your product? What skills must your management team develop to successfully lead the business? What key policies and procedures must you implement and enforce to ensure that the business accomplish its objectives? Build a management team. What I suggest with this exit strategy is that you build a management team over a period of 3 to 5 years. Your business in its present state probably does not generate sufficient revenues for you to appoint an entire management team. I suggest the first step is to appoint a salesman or sales lady with the potential to become a leader in the business. But another important reason for this appointment is that you need to increase revenues to fund the exit plan. Salespeople should always be remunerated in such a way that most of their income is dependent on hitting sales targets. Offer a reasonable basic salary so that you can limit your fixed costs. Attract and retain a strong salesperson, the type of individual you want customers to build a long-term relationship with, by offering the salesperson a remuneration package that rewards sales performance. Then, recruit a potential operations manager, probably a person from your industry or a related field with strong leadership qualities. In smaller businesses, this is the person that must become the leader in your business. You want the type of person who can think strategically, a person with a strong interest in your field, someone who will think creatively about product development. You are probably going to need at least 4 years to mentor and develop this person. Lastly, recruit a financial manager. Financial managers are expensive, but their skills are valuable and may be applied across many different fields. A management buyout arrangement. Once you've identified the leaders, the future members of your management team, you need to get their buy-in to the exit strategy. Explain the exit strategy and present a share incentive scheme to the individual team members so that they have a vested interest in the success of the business. You might consider a share incentive structure as follows. Each member becomes a minority shareholder with 10% equity in the business. Offer each individual member a long-term loan equal to the value of a 10% stake in the business. Team members share in the profits of the business, but their profit share is allocated to paying off the long-term loan related to the purchase of their stake in the business. And lastly, include a provision in the agreement where share allocations vest only after 5 years. If the team member leaves, they lose their stake in the business. You want to retain these people and, more importantly, convince a prospective investor that they are going to stay. Then you need to succeed at trading. Trading takes place within a context where your business engages with external parties, including suppliers, service providers, sales channels, and customers. Before you can set financial goals, you need to understand the commercial context within which you operate. You must come to grips with your business's trade cycle and duration. And it is here where the competency of the management team is tested. Do you have the right processes in place to identify and contract with the right suppliers? What are the risks inherent in the trade cycle and how do you manage these? How do you find new customers? What are your sales targets and revenue targets? How effective are you at collecting sales revenues? What is your gross profit margin and is this good enough? When it comes to the moment when you present your business to a prospective investor, you want to showcase the competency of your management team. You must present a track record of successful trading, substantiated with a set of financial statements. You want the investor to have confidence in the abilities of the management team. Implement financial controls. Based on your understanding of the trade cycle and within the context of your business model, you must convert the strategy into plans, set financial goals, and implement systems to monitor progress. And most importantly, you must be able to present the financial track record of the business to investors in a compelling manner. Do you have a single-page view of the most important financial metrics for your business? Is the information up to date and relevant to prospective investors? Identify sources of capital. At various stages of your business's development, new sources of capital become available. What must be accomplished to position the business in such a way that it can secure capital from financiers for various needs? What are the most effective finance solutions for the business's needs? And what alternative sources are or could become available to the business? The art of raising capital from investors. The successful sale of your business to investors is contingent on the previous 6 steps. You can be terrible at presenting, at pitching your idea to investors, and still succeed at selling your business to investors. Why do I say this? Because investors are looking for you. Capital is not as scarce as it is made out to be by many commentators. What is scarce is businesses with a clear competitive advantage, a strong management team, and a track record of successful trading. If you are a business owner aspiring to build your business into an asset of value, you need to craft an exit strategy to ensure that you derive maximum value from selling your business one day. I would very much like an opportunity to talk with you to see if there are prospects for us to work together. Our first conversation will be very informal. No need for financial statements or any other documents. I want to get to know you and your business first. My email address reflects on the screen. Thank you for your attention and all the best with your business.